Have you ever wondered what separates successful investors from the rest of us? It's not just about luck or timing, it's about having the right mindset and strategy. In today's video, we'll unravel the timeless wisdom of one of the most influential investment books ever written, The Intelligent Investor by Benjamin Graham. Whether you're a seasoned investor or just starting out, the lessons from this book could change the way you think about money forever. Benjamin Graham was more than just a financial analyst. He was a mentor to some of the greatest investors of our time, including Warren Buffett. His book, The Intelligent Investor, first published in 1949, is often regarded as the Bible of value investing. But why has this book stood the test of time? What makes its teachings so relevant, even in today's fast-paced financial world? Let's dive into the core principles Graham laid out, principles that have helped countless investors protect and grow their wealth over decades. Graham begins by distinguishing between two key concepts, investing and speculating. It's a distinction that might seem subtle, but makes all the difference. Investing, according to Graham, is about making a careful analysis and protecting yourself from significant losses, while speculating is akin to gambling, taking high risks with the hope of high returns. Ask yourself, are your financial decisions based on solid analysis, or are you just chasing the next big trend? This question is crucial because it helps you assess whether you're building a stable financial future or risking it all on uncertain bets. To truly grasp the importance of this distinction, let's rewind to the stock market crash of 1929. Millions of investors lost everything because they were speculating rather than investing. They were caught up in the frenzy of rising stock prices, ignoring the underlying value. What happened next was catastrophic, but there's a lesson here and we'll come back to it later. Next, Graham introduces us to one of his most famous concepts, Mr. Market. Imagine this. Mr. Market is your business partner, but he's a bit of an emotional roller coaster. Some days, he's euphoric and offers to buy your shares at a ridiculously high price. Other days, he's depressed and willing to sell you shares for a pittance. The question is, how do you react to Mr. Market? Do you let his mood swings dictate your investment decisions? Or do you stay calm and rational, only buying when prices are low and selling when they're high? Graham's point is clear. The market's irrationality can be your greatest ally if you learn to take advantage of it. Have you ever sold a stock in a panic only to watch it rebound later, or missed out on a great opportunity because you were waiting for the perfect moment? Understanding Mr. Market can help you avoid these common pitfalls and make better investment decisions. One of Graham's most crucial lessons is the concept of the margin of safety. Simply put, this is the difference between the intrinsic value of a stock and its market price. The larger the margin, the safer the investment. It's like driving on a mountain road. Wouldn't you rather have a wide, sturdy guardrail than a flimsy one? This principle is particularly relevant today, with markets more volatile than ever. It's not about predicting the future, but protecting yourself from the unknown. The margin of safety gives you that buffer, that extra room for error. So even if the market turns against you, your investment remains secure. Remember the story of the 1929 crash. Many investors didn't have a margin of safety. They were over-leveraged, buying stocks on margin without considering the risks. When the market crashed, they were wiped out. But those who adhered to Graham's principles, they survived, and many thrived in the years that followed. Investing isn't just about numbers and analysis. It's about controlling your emotions. Fear and greed are the two biggest enemies of investors. Graham emphasizes the importance of emotional discipline, being able to stick to your strategy even when the market is in turmoil. Imagine this. The market is crashing, headlines are screaming, and everyone around you is selling in a panic. What do? Graham's advice is simple. Stay calm. If your investments are sound and you've done your homework, there's no need to panic. In fact, these could be the best opportunities to buy. How often do you let your emotions dictate your financial decisions? Are you more likely to buy when everyone else is buying, or sell when fear is in the air? Recognizing these patterns in yourself can help you become a more disciplined and ultimately more successful investor. At the heart of Graham's philosophy is value investing, looking for stocks that are undervalued by the market. These are companies with solid fundamentals that for whatever reason are being overlooked or underestimated. Value investing is about patience, about finding those hidden gems that others have missed. But how do you identify these opportunities? Graham suggests looking at the company's financials, its earnings, dividends, and growth potential. Is the company being sold for less than it's worth? If so, it might just be the perfect addition to your portfolio. Let's take a moment to talk about one of Graham's most famous students, Warren Buffett. Buffett took Graham's lessons to heart and built one of the most successful investment careers of all time. But it wasn't always smooth sailing. In fact, some of Buffett's early investments seemed like risky bets. So, what made them successful? We'll explore that in a moment. Graham's approach to investing is the antithesis of the get-rich-quick mentality. He advocates for patience, for thinking long-term, rather than being swayed by short-term market fluctuations. Investing, in Graham's view, is not about timing the market, but about time in the market. Consider this. How often do we get caught up in the latest trends, looking for the next big thing? But Graham reminds us that wealth isn't built overnight. It's built through consistent, disciplined investing over time. The stock market, in the short term, is a voting machine, but in the long term, it's a weighing machine. The true value of your investments will become apparent over time. Warren Buffett didn't achieve success by chasing the latest market trends. He applied Graham's principles, buying undervalued companies, holding them for the long term, and exercising patience. And it paid off. Buffett's success story is a testament to the power of Graham's teachings. So, what can you take away from The Intelligent Investor? Investing isn't about predicting the future, it's about preparing for it. By following Graham's principles, distinguishing between investing and speculating, understanding the importance of the margin of safety, maintaining emotional discipline, and thinking long-term, you can build a solid financial future. If you found these insights valuable, make sure to like this video, share it with others who might benefit, and subscribe to our channel for more content on mastering your financial journey. And until next time, invest wisely.